Silver to $3,947 an ounce. That is the number that detonated across the precious metals world this week. Most people laughed. They dismissed it. They called it fantasy. But when you slow down and decode the math line by line, something uncomfortable happens. The number stops looking insane, and the real argument shifts. It is no longer about whether the math works. It is about whether the assumptions behind the math can ever become reality. That is the conversation we need to have today. Because once I broke this down from the ground up, I realized something that changed my entire view of where silver could go in this cycle. Even the boring version of this thesis points to a move that would shock almost everyone watching this video. So here is exactly what happened. A macro framework started making the rounds, linking US debt, gold revaluation, the Dow priced in gold, and the gold-to-silver ratio into one single chain of logic. Follow that chain all the way through, and you arrive at the headline number, silver at $3,947. But the headline number is not even the most interesting part. The most interesting part is that when you start cutting the assumptions down, making them more conservative, making them less dramatic, the target for silver is still absurdly high compared with where it trades right now. That is what should get your attention. Not the top-end fantasy. The fact that the low-end case is still explosive. To understand where this number comes from, we have to begin with debt and gold. Not hype, debt and gold. Because the foundation of this entire argument is the relationship between the value of America's gold reserves and the size of the debt sitting above them. During the World War II era, the United States carried massive obligations, but the value of its gold reserves represented a far larger share of that debt than it does today. At the peak of that framework, roughly half of federal debt was effectively backed by gold. That mattered. It gave the currency an anchor. It gave creditors confidence. It imposed discipline. Fast forward to today, and that relationship has collapsed. The gold is still there, but the debt has multiplied around it so aggressively that the reserve backing percentage has fallen to a tiny fraction of where it once stood. That is the first key insight. Gold has not kept up with debt. Debt ran away. Gold did not. And history shows that when that gap becomes extreme, gold does not politely ask for permission to reprice. It reprices violently. That is exactly what happened in the 1970s. The quantity of gold stayed the same, but the price adjusted to reflect a new monetary reality. That is the template. And once you understand that, the viral math starts making a lot more sense. Here is the aggressive version. If current US gold reserves were revalued high enough to cover 51% of federal debt, like that World War II-era benchmark, the implied gold price would land around $75,000 an ounce. And if gold were $75,000 while the gold-to-silver ratio compressed to 19, silver would land near $3,947. That is the number everyone is fighting over. The arithmetic is not the problem. The arithmetic works. Divide the required reserve value by the gold ounces. Apply the ratio. The math is clean. The debate begins only after that. Does 51% backing ever return? Does the ratio really reach 19? Those are the real battlegrounds. And this is where I want to be blunt. I do not believe the 51% assumption is a base case. I do not think the world is walking back into some old-style gold anchor where governments suddenly rediscover restraint. That is the most aggressive version of the argument. But here is why dismissing it completely is a mistake. Because you do not need 51% to get a staggering gold number. Cut it in half and the target is still enormous. Use an 18% framework, roughly where the reserve picture stood around the 1980 gold peak, and the implied gold price is still miles above current levels. Even if you use a much softer revaluation, the gap remains huge. That tells you something important. This is not an all-or-nothing thesis. Gold does not need to go to $75,000 for silver to become a monster trade. It only needs part of the historical gap to close. Now we move to the second engine of this thesis, and this is the part that deserves far more attention. The Dow priced in gold. This ratio is one of the cleanest long-cycle signals in macro markets because it compresses a century of euphoria, fear, inflation, debt, and monetary repricing into one line. When the ratio is high, stocks are expensive relative to gold. When it is low, gold is expensive relative to stocks. And every major cycle has pushed this ratio from one extreme to the other. It topped in 1929. It collapsed into the 1930s. It rose again into the 1960s. It collapsed into 1980. It peaked again at a historic extreme in 1999. Since then, Despite every rally and every distraction, the long-term direction has been down. That matters because right now this ratio is still sitting near the same zone where the 1970s move really began to accelerate. In the early 1970s, the Dow-to-Gold ratio was around where it sits now, and from there, it did not drift lower. It collapsed. Gold massively outperformed stocks for years. If you simply assume that this cycle follows the same rhythm and the ratio drops toward 2.5, you get gold somewhere around the high teens in thousands of dollars per ounce, depending on where the Dow sits when it happens. That is not fringe math. That is basic division applied to a century-long pattern. And again, let's make it less exciting on purpose. What if the ratio does not go to 2.5? What if it only goes to 5? Gold still ends up around $10,000 if the Dow is near current levels. What if it bottoms at 3.5? Gold still lands dramatically higher than where it trades today. This is why I keep saying the extreme target is not the main story. The main story is that every reasonable version of the exercise still points to a major gold repricing. And if gold has a major repricing, silver does not sit quietly in the corner. Silver historically moves later, faster, and more violently once the precious metals complex goes from skepticism to mania. Now we get to silver. And this is where the analysis goes from compelling to explosive. Because once you have a gold framework, the next question is simple. How much does silver outperform if the precious metals complex enters a true blow-off phase? Right now, 1 ounce of gold buys roughly 60 ounces of silver. That ratio is already far below the panic extremes we saw in 2020, but it is still historically elevated versus what happens in strong precious metals bull runs. During those runs, silver does not merely rise with gold. It catches up. It compresses the ratio aggressively. That has happened again and again. The only debate is how far the compression goes this time. The aggressive case uses a ratio of 19, and to be fair, that number is not invented out of thin air. It has historical precedent. But this is where I part ways with the base case. I do not think 19 should be treated as the default assumption. It is possible. But it lives on the hotter edge of the spectrum because it implies a level of silver enthusiasm that usually shows up in the final manic stage, not the middle of the move. A more grounded range, in my view, is somewhere around 30 to 35 for a conservative target and 20 to 25 for an optimistic but still defensible target. Now watch what happens when you apply those ratios to a gold repricing. If gold reaches roughly $19,800 and the ratio compresses to 35, silver lands around $566. If the ratio reaches 25, silver moves to around $792. If gold only reaches $15,000 and the ratio still compresses to 35, silver lands above $400. Read that again slowly. You can lower the gold target. You can use a less dramatic silver ratio. You can make the assumptions deliberately dull, and silver still comes out several multiples above current prices. That is the part most people are failing to appreciate. You do not need the moonshot scenario for this thesis to become life-changing. You only need history to rhyme. Now let's deal with the bearish pushback because this is where weak analyses usually fall apart. The main counter-argument says this entire framework ignores supply. The idea is simple. If silver prices rise, miners respond. Production rises. New supply hits the market. The shortage eases. Price gets capped. On paper, that sounds sensible. In the real world, it runs into a wall called time. Mining is not software. You do not click a button and produce massive new ounces next quarter. New mines take years. Expansions take years. Permits take years. Capital allocation takes years. The demand shock happens first. The supply response limps in later. History is ruthless on this point. In the 1970s, precious metals exploded despite higher prices supposedly being the cure. The cure arrived late. Macro repricing moved faster than mine supply. And silver has another complication that many people overlook. A huge share of silver is not mined in pure silver operations. It is produced as a byproduct of other metals. That means even a higher silver price does not automatically unlock an equally aggressive response. The silver market is less elastic than the textbooks make it sound. And look at what is happening right now. Silver has been running deficits for years. Prices are massively above where they were just a few years ago. And yet the market still feels tight. Physical availability still matters. Refining still matters. Inventory still matters. If higher prices were an instant self-correcting mechanism, that correction would already be obvious. It is not. Because the structural issue is not just price. It is the speed of the demand shift colliding with a sluggish physical response. That is exactly the kind of setup that produces disorderly price behavior. The second bearish point is more nuanced. Silver is not officially monetary in the way gold is. Central banks do not pile into silver reserves the way they do gold. That is true. Gold gets the sovereign bid. Silver mostly does not. But here is the mistake bears make. They act like silver therefore cannot participate in a monetary repricing. History says otherwise. In the 1970s, silver did not need formal central bank sponsorship to explode. It needed inflation, debt stress, broken confidence, and a wave of speculative and investment demand layered on top of industrial demand. Monetary panic does not ask whether central banks love silver. It asks whether investors are hunting assets outside paper promises. And today, silver has something else working for it: strategic relevance. It may not sit in central bank vaults as a reserve asset, but it sits at the center of electronics, solar, defense systems, medicine, and advanced industry. In a world of supply chain stress and geopolitical fragmentation, strategic metals gain a different kind of bid. And if investment demand piles on top of that while gold is repricing, silver becomes one of the most unstable markets on the board in the best possible way for longs. Small market, tight structure, violent upside once momentum turns. Now let's be responsible and talk about what could break this thesis. Risk number 1. Governments somehow stabilize debt without a major currency event. I think that is unlikely, but it is a real risk. Risk number 2. We get a hard liquidity crash first. In that scenario, everything gets sold temporarily, including silver. Long-term bullish does not mean straight up. Risk number 3. Industrial substitution reduces demand growth. Not tomorrow, not likely soon, but it is a variable that exists. With those risks on the table, here is where I land. The directional thesis is strong. Gold looks deeply undervalued relative to debt. The Dow-to-Gold ratio still points to an unfinished long-cycle repricing. And silver, if the ratio compresses the way it has in prior metals bull markets, has room for a move that still sounds absurd to most people. Where I push back is on the exact headline number. Silver at $3,947 is not my base case. That number requires the most aggressive debt backing assumption and a very extreme ratio compression happening together. Could that happen in a panic? In theory, yes. Do I build my framework around it? No. My framework is simpler. Conservative case, silver above $400. Moderate case, silver between $500 and $800. Hot case without full fantasy, silver over $1,000. That is where I think the real discussion should be. Because those numbers do not require miracles. They require historical relationships to move in the same direction they have moved in every major prior cycle. That is it. And the timeline matters. This is not a next week prediction. This is a multi-year repricing thesis. The 1970s did not go from disbelief to peak mania in 5 minutes. It took years. Think about what those numbers actually mean in the real world. Silver above $84 today going to $400 is nearly a 5-fold move. Going to $600 is roughly 7-fold. Going to $1,000 is the kind of move that rewrites portfolios and changes lives. And none of those outcomes require the full viral number. They only require a partial replay of patterns that have already happened more than once. That is why I think the most dangerous thing investors can do right now is dismiss the thesis because the top-end target sounds crazy. In every great bull market, the early numbers always sound crazy, until later, when they sound obvious. And there is one last thing that keeps pulling me back to this analysis. The precious metals market is tiny compared with the debt problem sitting above it. That imbalance is the real story. When you have a small pool of available metal and a vast ocean of credit, it does not take much capital rotation to create a violent repricing. People imagine these moves need universal adoption. They do not. They need marginal flows into a market that is simply too small to absorb them cleanly. That is why precious metals moves can feel impossible right up until they happen. And there are catalysts that could accelerate everything. A sovereign downgrade, a currency accident in a major economy, a bond market revolt, a deeper loss of confidence in the dollar framework, a new wave of visible physical tightness in silver. Any one of those can compress time. The long cycle thesis may point toward the early 2030s, but cycles do not move on neat calendars. They move when confidence breaks. They move when the market realizes the old pricing model no longer works. So no, I am not here to tell you silver is definitely going to $3,947. I am telling you something more important. The math behind that number is not nonsense. The extreme target is built on aggressive assumptions, yes, but the structure underneath it is real. Debt matters. Gold reprices against debt. The Dow-to-Gold ratio reverts. The gold-to-silver ratio compresses in metals bull markets. Those are not opinions. They are recurring patterns. That is where I stand. The extreme headline is the bait. The conservative math is the story. The market can argue all day about whether the ceiling is absurd. What it should be arguing about is whether silver at current prices makes any sense if this long cycle repricing is still alive. Because if it is, then silver's biggest move is not behind us. It is still in front of us. So now I want to know where you land. Is $400 your number? $600? Over $1,000? Or do you think supply growth and macro stabilization kill the whole thesis before it gets there? Whatever side you are on, the key is not emotion. It is the ratios. It is the debt. It is the historical pattern. Strip the noise out and the picture becomes very clear. This market is not fighting over whether silver is cheap. It is fighting over how cheap it really is. And that fight is going to define the next phase of this cycle. If you think the target is crazy, fine. But then show me where the ratios break. Show me where debt suddenly becomes manageable. Show me where gold stops repricing in stress cycles. Show me where silver refuses to outperform in a metals bull market. Because until one of those pillars actually breaks, the bigger risk is not that the upside case sounds too large. The bigger risk is underestimating how violent a tiny market can become when macro reality finally forces its way into the price. That is the real takeaway, not the viral number itself. The fact that even the toned-down version still points to a move most people are completely unprepared for.